In 2008, with the Great Recession, I lost everything, and it was brutal.
My guest today is Peter Goldstein. Today, it's going to feel for me like we're having a conversation, just two old buddies who have been through the industry for the last 20 plus years together. But what are you up to these days?
My primary focus is EMMIS. So it's a SPAC trading on Nasdaq. We raised $100 million, which was oversubscribed. So you have $115 million in treasury. And the mission is simple, Seth. We are creating a clear and efficient route to Nasdaq for private companies that want to have post-merger and execution support.
But for those CEOs that are listening out there that might want to go public over the next 6, 12, 18 months, what advice might you have for those executives?
You're in a completely different business.
Once you're publicly traded.
The most simple answer to your question, Seth, is about preparation and optionality. And the biggest myth is that they're comparing themselves to comparable companies that are like 100x their size. The public markets are like a mirror. They don't care about your intentions. They care about what you execute upon.
Good afternoon and welcome to the podcast. Today, it's going to feel for me like we're having a conversation, just two old buddies who have been through the industry for the last 20 plus years together, and just rehashing some of the old times and talking about some of the current opportunities that are going on in the capital markets. My guest today is Peter Goldstein, and when I say that he's an EMMIS guy, a truthful guy, he's the real deal. And the reason I say that is because his most recent venture is EMMIS Acquisition. He's the CEO of the company, which is a SPAC that is publicly traded on the Nasdaq. And we're going to talk about his journey, and we're going to talk about a lot of things that I think are going to be super helpful for anybody contemplating going the IPO route or getting involved with SPACs or capital markets or entrepreneurship and leadership as a whole. So with that mouthful, Peter, welcome to the podcast, and thanks for taking the time.
Thanks for having me, Seth. I was really looking forward to this today. It's just like you said, two, kindred spirits, and we've been through the trenches together and have a friendship that goes back through many market cycles, many exits, many wins, many losses, and looking forward to just having a dynamic conversation.
That is well said. The ups and downs of public company life, but. Why don't we do this? Why don't we start off with the here and now? Tell us a little bit about what you're doing, what you're working on, and then we'll back into sort of the journey and some lessons that we can all learn from that process. But what are you up to these days?
My primary focus is EMMIS, and as you know, as board member and as our transfer agent.
Right, I should say that, right? I mean, whatever legal disclaimers there are that need to be done on an average podcast, I am a board member of EMMIS Acquisition. Thank you for reminding me of that. Go ahead.
Well, we're covered. So,
yes.
Look, EMMIS is it's a SPAC trading on Nasdaq. We raised $100 million, which was oversubscribed. So you have $115 million in treasury. And the mission is simple, Seth. We are creating a clear and efficient route to Nasdaq for private companies that want to have post-merger and execution support. So, specifically, we engineered this vehicle for alignment. We structured it with, a very unique capital structure. We wanted to have to bring a sponsor that has an ecosystem around execution, right? So legal, audit, transfer agent, banking, institutional support. And our target profile, different than some of the other SPACs that are out there, is a fundamentally strong operating company. So we want a company that's already demonstrated revenue, cash flow, and growth, along with public-facing management. Many SPACs are going after more future growth stories in hot sectors, which again, there's nothing wrong with that. Our choice is to go after more fundamentals. So we're focused on more of the industrial sector, which is pretty broad by itself, includes services, manufacturing, technology, consumer goods, but where fundamentals are real. We're geographic, global in our scope. And our criteria is to find a company that has $100 million in revenue and north, an EBITDA of $10 million and north, that is audit ready. And the the approach that we're taking is discipline, right? So we're bringing a very disciplined structure and a founder-led execution, because that's what I believe, Seth, is what the market wants to see these days.
I feel like every SPAC that comes out is very much focused, I think, on the team, the captain of the ship, and what their background is. I know that, for example, in 2008, 2007, when my partner and I sold Vintage Filings, because we did one great deal, we were looked at as like financial services gurus, right? Just because we did one. And so people approached us back then, oh, you guys should do a financial services SPAC. We see that there are other people that are really successful in biotech or medtech or pharma. They may start a SPAC. But I feel like the ideal situation is somebody who understands capital markets and IPOs. So is that what prompted you to start the SPAC? Or why don't you tell us, like, what was that aha moment where you said, you know what, why don't I just do this?
Yeah, it's
Give us some
really
insight to that.
it's a great question, and I'm a big believer as an entrepreneur, Seth, in product market fit. Meaning, you could design the greatest widget in the world and nobody wants to buy it. It's not a good business. In a product market fit, there's demand for the product already demonstrated before you bring it to market, and that's what happened with EMMIS. Is in 2024 the regulations changed, so the 2021 and 22 you had this big arc with SPACs, and everybody and their brother was in
Yep.
that space, and then it blew up. Most of us in the industry know that story. In 2024 we started getting inbound requests for looking to do SPAC deals, because the IPO market is uncertain and has its own challenges. And then that shifted even further. So when I started looking to see, can I make a fit between an existing SPAC and a target company, I realized that there are challenges and nuances within creating a SPAC. And so, as the entrepreneur in me, I said, if I'm going to be able to do this, let me go out and create my own. I've been doing SPAC-like transactions for 25 years. It's just different to actually build a formal SPAC. And the combination, if you will, the change in the regulatory environment, the market demand, and the desire to do this, as CEO, and being able to build it so that we have more input, more selection, more discipline about the outcome, because value gets created only post-market in the value of the equity. And so I want to be able to drive all those simultaneously, and then to be able to bring a solution that I felt was missing from the marketplace.
If I'm being candid, one of the reasons that I felt, besides honored, humbled, and comfortable to join this SPAC, was knowing your experience, what to look for. So many times a CEO will go through this process, but it's his first time at the rodeo, right? And so that comfort level of, is he going to learn on the fly fast enough? Tell us a little bit about the journey. I think when we met 20 plus years ago, you were in the brokerage firm maybe, and there's been a lot since then. Give us a little bit of insight of, you didn't graduate high school and said, I want to be a SPAC CEO one day. That's for sure.
No, I can't say that was the master plan. And just before I get into the journey, I can tell you what I really strongly believe is what you said. Is part of the discipline with EMMIS is what holds after the closing, and it's the same with an IPO. It's not getting there that counts. That's a critical part of the journey. It's then what happens, and I think here it's risk management. And it's so critical out of the experiences that I've had. I was fortunate, Seth. I started my career in my 20s, and I had my first exit at 30, and I learned more in that first exit than I have probably in about how to organize an exit properly, because it was not a great exit. I made money and everybody did well, but things could have gone very, very differently, and that set me off in a career around working with emerging growth companies all over the world. Founder, CEO, chairman, investor. And then, as you said, I owned a broker dealer, which I started from scratch. I eventually sold it But I've been probably on I think all sides of the table, which gives me unique perspective to be able to talk with an entrepreneur, to be able to talk with a board, to be able to talk with management. And then the big reset happened for me. So in 2008, with the Great Recession, I lost everything, and it was brutal. So, that period taught me the difference between momentum and resilience. That, the pressure didn't create the problems, but it revealed what it was at the time. So, the journey has been and continues to be a learning process. I love the entrepreneurial spirit. I know you have it. I know I have it. And it's what continues to get me up and motivated and working every day.
I think that it's very noticeable. Anybody who hears you speak, like they hear that tone of like leadership and that tone of entrepreneurship. If I'm not mistaken, you went back to school recently for an advanced degree. Was it in entrepreneurship or something along those lines, which super impressed me because, it's one thing when you have these conversations with, even the young kids that I speak to today, they're like, oh, what do I need college for? I'll just go straight to cash advance, or I'll buy real estate and I'll flip it and I'll make the money. And by 23, I'll be done. I know I don't have the stamina to go back to school, but you did. Tell us why, what you did, how was that?
I have a couple different stories there for you. The first one goes back a long way, but I'll just give you the short story on it. Was like many kids, when I had at the college age, I had to focus on making money. So I actually dropped out of college and I started my first business in my 20s. I exited at 30. Then I went back to school and I got my master's degree in international business. But that's 30 years ago, Seth. So roll the tape forward. I have 2 advanced certificates, or not degrees, but certificates that I did in the last few years. One is at Harvard, and I did two modules there. It ended up being a year on campus on a hybrid program with leaders from all over the world on corporate governance. And I wanted to bring governance at the highest level down to small cap and micro cap. And it was a phenomenal experience. People were there from all over the world and in much larger, kind of organizations where you and I spend most of our time. The second one that I did was in Europe at a school called INSEAD. INSEAD is kind of the equivalent of like a Harvard, and it's based in Fontainebleau, France. And because I spent a lot of time in Europe and I wanted to bridge the gap between Europe and bringing deals to the United States. And I believe that one of the areas that is quite, strong for me now that I see as a discipline is bringing governance to companies so that they can operate with a structure that supports management in continued stakeholder rewards.
That again is super impressive that you had the drive and the commitment to go back for further education in these very specific categories. You had mentioned that one of your degrees was international. You spent time in Europe, but I also know you've spent time all over, right? I mean, also Singapore, or was it Malaysia? Yeah, I mean, I'll let you tell it, but from I'm the kid from Brooklyn, and I've mentioned this before on the podcast. For me, like anything past Staten Island or the Jersey Turnpike is like foreign territory and international. And I acknowledge that I think that limits my view of the world on a global level sometimes. But it seems like you don't have that issue. Tell us, where have you spent some time, and you've really committed to those areas, and how was it?
Look, there's something, the combination of lifelong learning and travel is just it's a calling for me. And then doing business internationally with the nuances of cultures, with business norms, and with the opportunity now, as we know, with technology, to have a global, footprint and a global platform. That called me early on in my life, and I've had the ability to travel, almost all over. I would say this past year, I think I was in 14 or 15 countries, and was spent significant time in 3 continents between the U.S. And Europe, and then Asia. I spent the last 3 months of 2025 based in Singapore and traveled throughout Asia to look at companies that were foreign private issuers that wanted to access the U.S. capital markets. Because as you know, in small cap, that has been a historical trend. But prior to last year, I've had the benefit of being able to travel both for business, which then I combine with pleasure, and I combine with, being able to be a historian within, the capital markets. I think now I've seen 17 or 18 stock exchanges around the world. And I've got a plan to go see another one here in the next month. So it opens up, I think what it does is it opens up the world to more opportunities, to understanding people, to being able to understand business, and to be able to work at a more of a macro level, even that we can bring down to our small cap and micro cap segments.
That's incredible. And I think that adds to your viewpoint of analyzing these companies, right? Having this international sort of lens to look at them through, even if they're domestic targets or international targets. Can you pull back the curtain a little bit and tell us what do you what scares you? What's a red flag when you're looking at a pitch deck? I mean, I would imagine you see a lot of companies based on introductions from referrals because you have a very vast network, and you've seen a lot of pitch decks. What are some of the things that stand out that allow those issuers to get to the next stage of a conversation or a meeting? Or what are some of the red flags that you're like, this is not even worth my time? Because I know you're very selective.
Yeah, selective is part. Speed is not what we're looking for here. We're looking for discipline in this stage of leadership. In earlier leadership, I think it was more about getting to a quick decision. But early on, we start with the economic structure, at least for EMMIS, because the listing metrics and our criteria are the gatekeepers to what we want to do. Nasdaq has clear criteria. We have clear criteria. After that, then we start to look at the growth opportunity, and we look at management, and it's pretty fundamental thinking, Seth. There's no great ahas there. The flags start to come when the story falls apart, when the financial assumptions can't be defended, when it's all about forward-looking momentum, and there's no proof, no validation, no third-party authentication, if you will. So, we pretty quickly, I can almost surgically assess a company now, and we do so very, very quickly because we are looking at opportunities. And we then, if all that aligns, then it's cultural fit, which is incredibly important to me now. And to me, cultural fit is, like you and I, like-minded entrepreneurs who have clear understanding of what we're building, what our goals, what our metrics are, and how we define success together.
You are rightfully so focused on MS and the potential target, because I think we both recognize that although a SPAC has 18 months to find that target, after that Nasdaq bell and the confetti and the champagne, that clock starts to move pretty quickly. And the race is on. But you've also been involved and have experience as an advisor, consultant to just traditional IPOs as well. So I'm curious if we could focus on that for a minute. Just, our audience is made up of startups, entrepreneurs, public companies, capital markets, iBankers. But for those CEOs that are listening out there that might want to go public over the next 6, 12, 18 months, what do you advise them that they should look at first? Is there something that they should fix now to start that being, public company ready process? What advice might you have for those executives?
Look, I love talking to those guys because I am kindred spirits there, and I am obviously, have been on different aspects of that journey. Up until the regulations changed in 2024 and the IPO market was more stable, I was pro IPO and still am for the right criteria and the right conditions. But the most simple answer to your question, Seth, is it's about preparation and optionality. There are reasons why an IPO might be more appealing to a company versus, a SPAC, and I can easily talk about the pros and cons there from my perspective. But that's like, you're driving down, the road. For you, it might be the BQE, and then you get to a turnoff where you have to make a split in the road. but 80% of that journey is really the same. And in an IPO or SPAC, the preparation and the readiness is so critical, because you need to get your audit done. You need to have your professional team. You need to have a board organized. You need to have systems and controls that take time to build in. It's like if you're an athlete, you have to go on the practice field and practice, practice, practice. You get in your reps, you do the hard work. You just don't show up for game day.
Right.
And what I've seen happen so often, including myself and companies I've advised and I've been a part of, is we get caught up in the transaction and the goal being to get the deal done, whether that's an IPO or that's a SPAC. And then you forget about a couple different things. And this is pretty classic. One is to make sure that everything is aligned to get there and executing your timeline. The other is, of course, what happens after listing. And that's probably the most critical mistake. So whether somebody chooses IPO or SPAC, at the day of that bell ring or the day of that listing, because not everybody gets to ring the bell, on the day of their listing, you're in a completely different business. And the cap markets guys know this, but it still gets overlooked because many of the way that things are organized now is about the transaction and then what happens. So for people that are going through this the first time, the biggest counsel I can give is surround yourself with guys that are current in today's capital market, so they know the real story. It's a joke, Seth, that you and I have heard over the years. If you've done 2 IPOs, you're an expert. Well, I like to ask that expert, when was their last one, and then you find out real quickly, because the market has changed. Even since I did my IPO with EMMIS with you, 3 months ago, completely changed. Right.
No,
so trusted advisors, knowledge
so
base, and then be prepared for life as a public company executive.
It's so true. I was just talking to a CFO of a public company, and he was questioning some of the things in terms of process. And it's not easy for anybody, but he's like, I don't need an education. I've been a public company CFO before, and then I looked it up, and it was 18 years ago. 18 years ago. So like, his math skills are probably there, but just process is entirely different, to your point. Also, to your point, it's an entirely different lift once you're publicly traded and the Nasdaq bell rings. As a matter of fact, full disclosure, I do not wear a white shirt every day for my podcast. I'd like to say I got dressed up for you, but I was at the Nasdaq bell this morning with a client, VenHub, and again, champagne and celebrations and confetti, but like at one point it's like, I got to get back to work. Like I don't have the time to spare. You had mentioned though that there is this fork in the road, IPO versus SPAC, and just to rehash what you had pointed out is that it's not like, hey, an IPO is a long process and an audit, and a SPAC is like an overnight solution. So they both require the time and the effort and the legal and the compliance and the readiness. So that being said, if you could enlighten us a little bit, at least from your perspective, I'm a CEO of a company. I've got the 100 million revenue, 10 million EBITDA in theory. Why go one way versus the other? What are some of the high level pros and cons of SPAC versus IPO?
Yeah, I think that the first thing that comes to mind for choosing one or the other is certainty. The IPO market has more uncertainty around it now, from regulatory perspective, from a timing perspective, and you're going to market, and you never know what's going to be happening in that market when you're ready to go, and so there's an inherent risk. And I think that risk is just increased because of the complexity of today's world, whether it's market driven, geopolitical, investors, you can cite a whole number of different reasons. I still believe it's fundamentally, sound, and you have to be built as an organization to want to be ready, and withstand the cost, the timing, and the uncertainty of an IPO. And many small cap and micro cap companies are not endured to, or built to endure that way. So then the SPAC becomes more interesting because it gives you more certainty. And what I mean by that is there's a higher likelihood of an outcome when you sign into a business combination with SPAC. You have certain things that you're going to know that you can go to market. You can know that you're going to be able to have a valuation that's agreed upon. ideally is validated by third parties and by institutional investors. And you know that there is a timeline that is predictable in order to go to market. So the reducing uncertainties, the reducing of risk gives you a higher probability of an outcome of getting listed. And that's what companies are seeking, so that they then have the benefits, which exist both in an IPO or in a SPAC, of what exists in the way of access to capital and liquidity and the credibility that comes in being a public company.
Interesting. And I imagine that when you have these conversations with CEOs, as I've had hundreds of these over the years, and not in a bad way, but the CEO always thinks that his valuation is like 4 gazillion times more than what it is. And when you ask him to explain why, and he's like, because it's my company. Like they don't even need to support it. It's just an emotional attachment towards that valuation and why they think they deserve what they're asking for. But is there any myth that you find readily apparent amongst the CEOs that you're talking to that you then, because I imagine you need to educate them a bit about how this all works and what it means for them. Even it's a two-way opportunity for them and for you. But is there any myth that you see these CEOs across the board that you have to sort of correct?
Yeah, I mean, you nailed it. No CEO is going to come in and undervalue his company. It's typically the opposite. They have a premium. And the biggest myth is that they're comparing themselves to comparable companies that are like 100x their size. We had a conversation earlier today with a tech company, a SaaS company, and they were comparing themselves, to a senior company that's, got $1 billion market cap. So valuation becomes really probably the biggest myth that exists. And it's also the biggest downfall in a SPAC. The difference, you go into IPO, it's a market. Investors will tell you what they're willing to pay at that time. In a SPAC, and this is why the SPAC market blew up, Seth, was that there were valuations that were created that were not validated by institutions and third parties. So assuming you were the CEO and I was the SPAC, we come to an understanding, sure, your company's worth $200 million, great, let's do a deal. And then they get to market, and the market says it's not worth 200. We don't even think it's worth 150. And then the stock is under pressure. And then we've seen this story before. So an example, what we're looking for, just like you would in an IPO, it's not a premium to market. You want a discount to market. Every investor needs to see an arbitrage. They need to see value. So the myth that you can state your own valuation in a SPAC deal, it's possible, but you're going to pay the price.
Right.
So the flip side of that is the fundamentals that we're bringing, which is bring a structured valuation, right? Have it verified based upon real comps, bring that to the investors, have the investors understand and agree to and validate that valuation at the time of going to market, not after, because after you pay a very meaningful price.
Well, I want to be mindful of your time, but if I can sort of wrap it up by asking you sort of, what do you see 3 to 5 years from now? Like, what is a great outcome of this venture look like for you?
A great outcome is that we've built a durable, sustainable public company. The public company or the public markets are like a mirror. They don't care about your intentions. They don't care what you say you're going to do. They care about what you execute upon.
It's a tough
right?
crowd.
It's
a tough crowd.
And so the de-SPAC is an accountability event, right? It's not a trophy. It's not going to be, hey, I did a deal. It's going to be that we are building value for all of the stakeholders, and that company is set up to be sustainable, meaning they are performing, they're executing, they have access to capital, right? Shareholders and stakeholders are being rewarded, and the company continues to grow to create more economic input or economic opportunities to serve whoever they're serving in their product or their service, and ideally, making a meaningful impact, in the business economy.
Well, we hope that you'll come back in however many months that is, and we'll do part 2, Peter Goldstein's de-SPAC, and I hope you'll give us the ups and downs and the ins and the outs. And then, like many, SPAC, serial SPAC people, you'll be telling us about MS 2, 3, 5, 15, and 20 acquisition codes. But in the meantime, the ticker symbol is EMIS. Is that correct?
That is
EMIS.
correct. That is
Fantastic.
correct.
Thank you for your time. Thank you for your insight, and we look forward to seeing where it goes from here. Thank you so much.
Always a pleasure. Always a pleasure. Thank you.
All right, Peter. We'll talk.